See that the governor is seated, Ruchi. Sir, it is a great privilege to have you with us here today. We can hear you and see you loud and clear. And we'd like to hand over to you for the keynote that we've really been awaiting with much eagerness. And of course, the session with Nikunj will follow after that. Over to you, sir.
Thank you for that introduction. And I must say it's great to see a lot of audience in the hall. And in particular, I would like to mention, and it's also great to see the presence of the tennis legend Andre Agassi amidst us. A very warm good morning to you all. It's indeed an honor for me to be here at the India Economic Conclave 2021, organized by the Times Network. I have been looking forward to participating in this event after my participation in this very event, which was held in Mumbai in December 2019. And that experience obviously enthused me to participate in this event once again. The theme of this year's conclave, one which resonates very strongly, is India's decade: reform, perform, and transform. The COVID-19 pandemic has set forth the wheels of transformation for everything around us, from our work life to our policy priorities. As we toil towards addressing the challenges raised by COVID-19 with the aim to emerge as a modern and transformed India, I applaud the foresight of the Times Network in selecting such a pertinent theme. Today in my address, I have chosen to speak on a subject which is in which the Reserve Bank has a major stake, and that is financial sector in a new decade. Contextually, it is important to bear in mind that unlike the global financial crisis, GFC of 2008, when financial sector vulnerabilities impacted the real sector, this time the risk of contagion is from the real sector to the financial sector. So it is the other way around this time. What I have proposed to do today is that I would first highlight a little bit about the global perspective, then talk about the Indian context, and then come specifically to financial sector. How do we look at the developments in the next, in this particular decade, that is the decade of 2020s. And I would also like to touch upon the activities and the developments taking place in the digital financial space, digital lending and digital banking, etc., with particular reference to digital payments also. Globally, the measures initiated in the last decade after the global financial crisis were aimed at reducing leverage and improving the quality and quantity of capital in the banks, among others. As a result, before entering the COVID pandemic, banks in India and banks world over were well capitalized and maintained high liquidity buffers, which, coupled with moratorium and asset classification freezes which have been announced by central banks across countries, these helped central banks and the banking system to stay resilient during these tough times. Measures taken by central banks and national governments, such as reducing policy rates, capital liquidity and regulatory relaxations, asset purchases, forex swaps, and government guarantees, among others, played a crucial role in preventing heavy sell-offs and protecting the balance sheets of banks. This collective endeavor resulted in stabilization of the financial sector and provided necessary liquidity support to maintain the flow of credit in economies across the globe. The rapid progress in vaccine has upgraded the global outlook, although we are not out of the woods yet, as fresh waves of newer variants of virus bring in fresh concerns. And this is something about which we have to be very, very careful and very watchful and take all the precautionary steps that we have been taking over the last 1 year. While the global economy continues to reel under the impact of this unprecedented shock, the near-term financial stability risks have been contained on account of coordinated interventions by central banks and governments across the globe. The present pandemic underlines the imperative of strong capital buffers in the banking system. While capital reforms undertaken post-global financial crisis did provide space to cushion the immediate impact of the current pandemic, Banks would need to shore up their capital position, both to absorb some of the slippages as well as to sustain credit flow, especially when monetary and fiscal measures start unwinding. While part of the global regulatory reform agenda is still under implementation, the pandemic provides an opportunity to test and evaluate the efficacy of various reform measures. The learnings from the crisis could throw up new focus areas to be addressed in the design of the international regulatory architecture for banks and other financial sector entities. Turning to the Indian context, we have to note that in the Indian context, maintaining health of the banking sector remains a policy priority. As I have stressed on several earlier occasions, the strength of the banking system depends on building its capital base, while at the same time focusing on corporate governance and ethics-driven compliance culture. Banks, as well as non-banking finance companies, that is NBFCs, need to enhance their skill set to identify risks early, measure them, mitigate the risk proactively, and build up adequate provisioning of buffers to absorb potential losses. They should also augment their internal stress testing framework with severe but plausible stress scenarios. Upgradation of IT infrastructure and improving customer services together with cybersecurity measures are other key issues which also need attention. On our part, we have reorganized RBI's supervision of the banks and NBFCs as well as the urban cooperative banks, UCBs. We have done that under one umbrella and initiated a series of measures to strengthen supervisory oversight on these entities. Our focus is more on early identification of risks, putting in place structured early supervisory intervention framework, and increasing the focus on root causes of vulnerabilities than on symptoms. We are also harmonizing the supervisory rigor across banks, non-bank finance companies, and urban cooperative banks. The Reserve Bank has also been taking steps to provide all-round support to improve the resilience of these sectors. We have taken several measures in the last 1 year, and even before that, I have listed it out in my speech, a copy of which will be uploaded in the RBI website. You could have a look at it, but I'm skipping the list of measures which we have taken, and in the interest of time. Now, turning to urban cooperative banks, I would like to stress that they are registered as cooperative societies and have been under the dual regulation of Reserve Bank and the state and central registrar of cooperative societies. The recent amendments to the Banking Regulation Act 1949, as applicable to cooperative societies, has brought the functions of governance, capital, audit, and amalgamation of cooperative banks under the regulatory domain of the Reserve Bank of India. In the recent period, we have taken a number of measures to improve the governance structure in urban cooperative banks. We have also taken steps to implement system-based asset classification norms and bring them into the CRILIC reporting infrastructure and under the supervisory action framework of the RBI. Last month, we have set up an expert committee to examine these issues and provide a roadmap for strengthening the urban cooperative bank sector. Now, I would like to now turn to the banking sector and the way ahead, especially in this decade from 2020 to 2030. The Reserve Bank is striving towards a more competitive, efficient, and heterogeneous banking structure. The licensing policies for universal banks, small finance banks, and payments banks are a step in this direction. Presently, we have about 10 small finance banks and 6 payment banks which are operational. I foresee going forward, 4 distinct sets of banking landscapes emerging in the current decade. The first set will be dominated by a few large Indian banks with domestic and international presence. The second set will be dominated by, and there will be several mid-sized banks with economy-wide presence. The third set would encompass small private sector banks, small finance banks, regional rural banks, and cooperative banks, which may specifically cater to the credit requirements of the small borrowers. The fourth segment would consist of digital players who may act as service providers directly to customers or through banks as their agents or associates. In fact, digital players would increasingly emerge as critical pieces across all segments. Let me now dwell upon the interplay and synergies that could be exploited by these four segments while they compete with each other to move up the ladder. Each of these segments needs to comprehend the future needs of society and respond to the growth in the Indian financial sector. IT systems need to be developed to handle exponential surge in the number of transactions. The example of the Unified Payments Interface, UPI, which took 3 years, that is from 2017 to 19, to register a monthly count of 1 billion transactions, but doubled to 2 billion a month in a short span of another year, clearly stands out in this regard. This demonstrates the need for scalability of systems and platforms in such a way that it can be easily scaled up, not incremental scalability, but exponential scalability. India is on the way to becoming Asia's top financial technology fintech hub with 87% fintech adoption rate as against the global average of 64%. The fintech market in India was valued at rupees 1.9 trillion in 2019 and is expected to reach 6.2 trillion rupees by 2025 across diversified fields like digital payments, digital lending, peer-to-peer lending, that is what we call P2P lending, crowdfunding, blockchain technology, distributed ledgers technology, big data, regtech, and subtech, to name a few. In a world where the fintech companies are leading in terms of volume of digital transactions and playing a more active role in the banking and finance industry, it is important that commercial banks adapt to the technological changes and work in tandem with these entities so that in future they are part of the ecosystem rather than competing with fintech companies for business. A meaningful collaboration and coexistence in providing affordable and efficient value-added services would help both the worlds. From the regulatory perspective, it is the RBI's priority to foster effective regulations with continuous knowledge acquisition so that we stay ahead of the curve. The Reserve Bank's endeavor is to ensure that the regulations do not constrain innovation. Rather, they should encourage and nurture innovation without compromising the need for financial sector stability, cybersecurity, customer protection, etc. Optimality in regulation and supervision is indeed the key. With this objective in mind, we have recently constituted a working group on digital lending, including lending through online platforms and mobile apps. Overall, an orderly growth of fintechs will benefit all stakeholders in the financial sector. While we are on fintech and technology, it would be extremely relevant to touch upon the developments in our payment systems, where India has shown remarkable progress in recent years. As the adage goes, the best way to predict the future is to create it. And at the Reserve Bank, it is our unwavering approach when it comes to, and this precisely is our unwavering approach in the Reserve Bank when it comes to future payment systems. With our commitment to foster innovation and provide state-of-the-art and safe experience to users, we have placed ourselves in the forefront of payment systems on a global stage. India has emerged as one of the leaders when it comes to payment systems, perhaps akin to the recognition in the COVID vaccine front that India has gained. Sustaining this position is both challenging and exciting. The growth rate of Indian payment systems has been indeed phenomenal, creating new records with each passing day. Digital payments volumes in India increased at a compounded annual growth rate of over 55% in the past 5 years, from 5.9 billion in 2015-16 to 34.3 billion in 2019-20, almost 6 times in 5 years. Retail payment systems such as UPI and Aadhaar-enabled payment service, AEPS, have changed the entire dynamics of retail payment systems as they are being used at every nook and corner of the country. Last year, and this is very important, last year when many other nations were writing checks to provide stimulus to the people, we in India processed 274 crore digital transactions. I repeat, 274 digital transactions to provide direct benefit transfer, DBT, to the people straight into their bank accounts. 24/7 and interoperability are two key aspects that are hallmarks of our payment system, and it will continue to be so. Interoperability is the sine qua non if the existing infrastructure has to be leveraged to its maximum and optimum use. RBI's recent initiative in setting up a Payment Infrastructure Development Fund, PIDF, to expand the reach of digital payment infrastructure into less penetrated regions is aimed at making payments more inclusive. The emphasis of the Reserve Bank is on operationalizing all our payment systems around the clock, 365 days a year. And I am happy to say that with 24/7 NEFT and RTGS systems, we are among a few countries that provide the facility to transfer any amount at any point of time during the day and at any point of time during the year. The success of UPI in India has attracted immense admiration from the international community, and several countries across the globe have expressed interest in developing a system on similar lines, which could provide a basis for stronger bilateral business operations and greater economic partnerships. The UPI system also has the potential to unfold into a cheaper and faster alternative to available means for multilateral cross-border payments as well. It would be appropriate to mention that our RTGS, and this is very important, it would be appropriate to mention that our RTGS also has multi-currency capabilities, and with 24/7 operations now, there is a scope, I repeat, there is a scope to explore whether its footprints could be expanded beyond India. With the Reserve Bank at the forefront of nurturing innovation, the day is not far when we will experience cheaper, faster, and safer cross-border remittances. Also, the indigenous RuPay card network has shown astounding growth across strata and has a significant market share. With RuPay having international presence now, our homegrown card network could make a mark in the global financial landscape going forward. The Reserve Bank is intensely involved in developing an ecosystem which would not only nurture future technologies, but also stimulate the technological aspirations of the financial community in India. On these lines, to enable the growth of fintech in India, the Reserve Bank in August 2019 entered into the elite class of select few countries which have their own regulatory sandbox ecosystem, where any regulated or unregulated entity can come and live test their innovative products or services in a controlled environment. This is a collaboration between the regulator, the innovators, the fintech, the financial services providers, and the end users, that is customers, which would ensure that Indian consumers continue to receive the best-in-class financial services. Additionally, the Reserve Bank has also created our own innovation hub, that is the Reserve Bank Innovation Hub. This hub will collaborate with financial sector institutions, technology industry, and academic institutions to exchange ideas and contribute to development of prototypes related to financial innovations. The Bank for International Settlements, that is BIS, and several central banks have also set up such hubs to stay ahead of the curve in technology absorption. While doing all these, we need to be watchful of the risks associated with certain technological innovations. That being said, while we are working on introducing a digital version of the fiat currency, the Reserve Bank is also assessing the financial stability implications of introducing such a central bank digital currency, that is CBDC. As the underlying technology is still developing, we are exploring ways for a clear, safe, and legally certain settlement finality, which is most crucial for a secure and efficient payment system. It also needs to be appreciated that there are not many practical instances of operationalization of central bank digital currencies across the world. This calls for utmost precaution so that we can produce a safe and robust model of central bank digital currency in India. And it is work in progress at the Reserve Bank of India. Enhancing cyber resilience is another important aspect when it comes to digital innovations. As we are expanding our operating hours and allowing for increased access and increased interoperability, there are persisting threats of cyber attacks to our systems. Experience shows that even the most efficient and protected systems can get compromised, which could expose stakeholders to disproportionate risks. The Reserve Bank is constantly creating awareness of such incidents and encouraging banks and non-banks to establish and maintain capabilities to avert such attacks. One must know also how to ring-fence such attacks when they occur and swiftly repair and restore the systems to normalcy. Cyber crisis proofing of systems by undertaking periodic tests as well as drills is indeed very essential. With increased digitization and development of fintech, the traditional ways of credit evaluation are expected to be replaced by new age credit evaluation methods that focus on a slew of non-financial and reliable transactional data. Many fintech firms have already adopted such an approach, but it is expected that in times to come, this may become more mainstream than remaining a niche. This will further facilitate the cause of financial inclusion in India. At the same time, however, it throws up a host of new challenges in terms of concerns of data privacy, consent, and security. Ethical behavior of stakeholders in payments value chain is important to surmount these concerns. Ability of financial sector entities to respond to these challenges may become a key factor. In fact, they are a key factor in the determination of their competitive advantage. Let me now just go to conclude this intervention. You would have seen that I highlighted a lot on digital, on the activities and developments in the digital space, and because that is the future, and both conventional banks, traditional banks, as well as new entities will have a lot to do in this area in the current decade. In the dynamic world of financial services, and more so after the pandemic, fintech is expected to challenge the financial sector with innovations and its exponential growth. Harnessing fintech for customer services will effectively control costs and expand the banking and non-banking businesses. The increased use of digital payments brought about by COVID-19 could fuel a rise in digital lending in the current decade as companies accumulate consumer data and enhance credit analytics. This in turn presents a new and complex trade-off between financial stability, competition, and data protection, and thereby warranting new regulatory frameworks and new ways of monitoring. It is imperative for the financial sector regulators to monitor global developments and formulate policy responses to the risks and the opportunities that are ahead of us. Going forward, banks need to address the financing needs of new sunrise sectors without undermining the traditional sectors of the economy. This conclave gives us an opportunity to look back on what has been accomplished and deliberate on what still needs to be done. I wish to reiterate that we at the Reserve Bank are fully committed to use all our policy tools to secure a robust recovery of the economy from the debilitating effects of the COVID-19 pandemic. The Reserve Bank remains devoted to build an enabling environment to develop the financial sector and create necessary preconditions for growth while preserving price and financial stability. Thank you very much. Thank you for your patience.
I'd like to invite 18 Hours Managing Editor Nikunj Dalmia for a one-on-one chat with the Governor.
Good morning. Thank you for joining us. My sincere compliments to RBI and to the Governor for managing the COVID crisis, for the kind of measures what Reserve Bank of India has taken during the COVID crisis. They have been indeed great, and they are the reason why Indian financial sector is very safe. Governor Das, while you alluded to the big picture, as a journalist, I'm tempted to first start with the near-term challenges. And the near-term challenge, Governor Das, is that unfortunately the COVID cases have been on a rise. Does that challenge your economic forecast? We were hoping, praying for a V-shaped recovery. Is it time to say the V could become U?
Look, in the Reserve Bank, we have never given our projections or forecast of growth in terms of any alphabets. But having said that, you are aware that we have given a projection for next year, the growth rate to be, the GDP growth rate to be 10.5. Our research teams are currently working on the incoming data on the high frequency indicators. And as you know, the next Monetary Policy Committee will come up in the first week of April or so. And we will give out our forecast on that. Now, I entirely agree that the renewed surge of COVID cases in many parts of the country is a matter of concern. But I think we have to also keep in mind that this time around, compared to where we were, let us say last year, March, or last year, April, this time around, we have some additional insurances against the impact of COVID-19 pandemic. The first is that there are 2 vaccines which are being rolled out, and the speed of rolling out that vaccine is, it's moving very fast, and about 5 crore people have been vaccinated. So that is number one. And number two, the second aspect is that overall the people are by and large more used to the COVID protocol. So one would expect the people, people who had, it appeared that they had lowered their guard, but I'm sure people will, sort of step up their guard against the spread of COVID pandemic. And third, at this point of time, one does not foresee a kind of lockdown that we had to, we experienced last year, because last year it came as a huge shock. This time we know what COVID-19 pandemic is all about, notwithstanding some new strains which have developed. So I would feel that the economic activity, the revival of economic activity which has happened should continue unabated going forward. And I don't foresee, although I should not be saying it before the details are presented before me by our research teams, but my understanding and our preliminary analysis shows that the growth rate in next year, that is at 10.5%, which we had given, would not require, I repeat, would not require a downward revision.
Can I say that a downward revision for growth is not required, but there is no need for an upward revision for inflation also, despite the fact that food prices and oil prices have gone up?
I can see the journalist in you, Nikunj. I will not bite that. I think you have to wait for the Monetary Policy Committee to give out the growth projections.
Governor Das, allow me to bring your attention to what is happening to bond yields. And it's a global phenomenon. They say never fight the central bank. But despite comments which have come from the US Fed early last week, and also what Reserve Bank of India is in a sense attempting to keep the yield curve under control, is there a question mark which has been raised now on central bank's ability to keep the yields under check?
No, I would like to say that there is no fight. I mean, there's no fight between the central bank and the bond market. At least I'm talking about India. And I have said earlier also that the relationship between the central bank and the bond, the bond market players, it's not, it need not be combative, and it has to be cooperative. What we are emphasizing time and again is that there should be an orderly evolution of the yield curve and not sudden spikes or any knee-jerk reactions to certain incoming numbers. Now, Government borrowing remains almost in the same region as it was, for next year. The borrowing numbers are the same as it is for 2021. But I have explained on number of occasions earlier that, the Reserve Bank is there very much on the, in the field. And the Reserve Bank, I have given out the numbers. In fact, I have given the arithmetic of it also. And I would just like to repeat for the benefit of your viewers and the audience here. You see, the central government borrowing, the net borrowing is 9 lakh crores. And current year, we have done open market purchase of government bonds of about 3 lakh crores. So next year, it's not going to be any less than that. If at all, it will be, it will be more than that. So you have 3 lakh crores coming from OMO's minimum 3 lakh crores. And we have also given special dispensation with regard to the, the hold to maturity dispensation, which brings in another 4 lakh crores. So 7 lakh crores is already available, and the gap is only 2 lakh crores. And we are confident that we will be able to manage the bond yields. All that we are emphasizing on and all that we would like to stress time and again is that an orderly evolution of the yield curve is very important for two reasons. Number one, a disorganized, disorderly yield curve evolution will act as an impediment for growth, will undermine the process of economic recovery, not just in India, but in all countries. That is why all central banks are concerned with this issue. And second thing is that why bond yields are important. Bond yields are important because they are the benchmark for the cost of money for the private sector. As you know, the private sector borrowing from the markets are benchmarked on the government securities of, let's say, 3-year or 5-year maturity, or sometimes 10-year maturity. So therefore, all that we are emphasizing on, and which central banks across the globe are emphasizing on, is orderly evolution of the yield curve. You would recollect Jerry Powell, the Fed chief, about 2 weeks ago, he also mentioned about the orderly, the ordered conditions of financial markets.
Governor Das, let me bring your attention to the currency. India's forex reserve, 4th highest in the world. What is RBI's definition of comfortable and surplus? Because that, in a sense, will tell us that what level Reserve Bank of India would like to say is necessary and what they would say is now getting surplus.
It's a dynamic situation. The first thing I would like to say is that there are two objectives in our forex intervention. One is to prevent excessive volatility of the exchange rate of Indian rupee vis-a-vis the dollar. There should not be excessive volatility, and that is the main theme of our intervention in the forex market. The second theme is that emerging market economies need to build up their own buffers. We have experienced and we have seen the adverse impact and the negative fallout of the taper tantrum of 2013. We cannot afford that kind of a situation again. Now, the expansionary monetary policy which the advanced economies are undertaking, at some stage, they will unwind and they will reverse. So at that time, the spillover impacts is maximum on the emerging market economies. And emerging market economies have nowhere to go but to look at their own buffers. So therefore, like any other, many central banks, Reserve Bank is also, we are building up our own buffers to deal with such situations. In fact, earlier, this approach was frowned upon by free market economists and those who emphasized very much on the market. But if you see the recent framework which has been brought out by the International Monetary Fund, IMF, even IMF has recognized that forex intervention has become necessary for emerging market economies to deal with volatile situations and to deal with adverse situations. Now, what is an adequate level? 20 years ago, mind you, 20 years ago, it was viewed that 1-year import cover is sufficient. But there are various parameters and yardsticks by which the adequacy of forex reserves is measured. Today, we have our import cover, our forex reserves, they sort of represent an import cover of about more than 18 months, that is more than 1.5 years. But internally, we have no such target of reaching a particular level of forex reserves. It all depends on so many factors, how the international situation develops. It's a very dynamic world, and we will have to deal with as the situation unfolds.
Governor Das, but looking at the fact that the economy or Indian economy is changing, PLI schemes, we are trying to move towards global competitiveness. Is Reserve Bank of India committed to keep the rupee competitive?
We will keep the rupee stable. The exchange rate, it's our endeavor always to keep it stable, because certainty and stability is good for investors, it is good for importers, it is good for exporters. In fact, it is good for all stakeholders in the economy. It is also good for, thousands of Indian students who go abroad to pursue higher education. So stability of the Indian rupee is the fundamental principle which we tend to follow, which we do follow at the RBI.
Okay, I'll take the liberty of asking you 2-3 more questions more. I know I'm shamelessly extending my appointment with you. Governor Das, has the government taken RBI's opinion on which are the government banks which should be privatized, something which the finance minister referred to in the parliament when she tabled the budget?
This is a matter which is constantly under discussion between the central government and the Reserve Bank of India. And it's a subject which is constantly discussed. But yes, government doesn't need to sort of we had discussions definitely before the budget and more after the budget. So naturally, the process going forward, we have the central government always takes into consideration the viewpoint of the regulator, and we are under discussion on this issue.
Is there a difference of opinion on cryptocurrency? That's the sense which we get if you look at what the Reserve Bank of India has stated publicly versus what we got from the finance ministry?
I don't think the finance ministry has, or the Reserve Bank, they have given any different points of view. All that we have flagged to the government, and I have reasons to believe that the government is in agreement, is that central bank digital currency is one thing. The cryptocurrencies which are being traded in the market is something else. Both RBI and government are committed to financial stability. We have flagged certain concerns around these cryptocurrencies which are being traded in the market. We have flagged certain major concerns to the government, and it is still under examination in the government, and government will come out with a decision sooner than later. I think that is what the government have, at various levels the government has articulated. I don't think there is any difference of opinion.
Governor Das, Bill Gates famously said, banking is necessary, banks or not. In this decade, since we are talking about the theme of this decade, how exactly is Reserve Bank of India ready for the changes which will happen? One side, you've got banks, the relevance of banks. Second side, you've got fintech. On the other side, you've got NBFCs, which are becoming fintech. Very dynamic changes are happening. Is Reserve Bank of India prepared for it?
You see, that is why, in fact, this is precisely the background in which I devoted considerable portion of my address to fintech and to digital, digital appraisal of credit sanction, to digital appraisal, to digital methods of lending, etc. So going forward, the digital methods are going to play a major role, but the banking sector will continue to remain relevant, and banks have a major role to play. What I emphasized is that the banks also need to adapt new technologies and adapt the changes and the transformations which are happening in the world of digital lending and in the world of digital technology to remain in sync with the times. In India, I see a situation where the banks will continue to remain vigilant, but the method of operations of the banks, the method of working in the banks, for the banks to reach to sort of promote financial inclusion or to reach a wider segment of the credit market, I think the methods will be more technology dependent going forward.
Right. Final question, Governor Das. In this pandemic crisis, for you personally, what has been your most joyful moment? What has been your most painful moment?
Well, painful moment has been that, so many people losing lives. I'm not trying to sort of, this is something about which I'm saying this in all seriousness. I mean, so many people losing lives. Livelihoods have been lost. We have, many of us or our friends, we have lost our near and dear ones. So that has been a very painful moment. You hear suddenly somebody you know, or that he is no more. And so that has been a very painful moment from time to time when you hear such news. And the most joyful moment, well, the central banks have to always keep their fingers crossed. The central bank governor has to keep his finger crossed, be very watchful, should not should not ever bask in happiness or joy that the innings is over and a half century or a century has been scored, because every day is a new challenge.
Well, Governor Das, on behalf of everyone from the Times Network and everybody present here, thank you very much, and my sincere compliments to Reserve Bank of India. You've made the impossible look easy. Same time last year there was gloom and doom and there was fear. Now we are talking about growth. That time we're talking about depression and contraction. Really appreciate your time, sir, and thank you for joining us.
Thank you, Nikunj, and thank you to all your viewers. Thank you. Namaskar.